Webinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. Thank you for coming to our webinar presenting some interesting findings on data from FXCM. My name is Ernie Chen. I am a fund manager at QTS Capital Management. And in my earlier days, I worked as a quant researcher and trader for Morgan Stanley, Credit Suisse, and a number of hedge funds for the last 20 years. I also wrote a number of books, and most recent one being Machine Trading, deploying computer algorithms to conquer the market. And I have a blog that you might want to check out that has a lot of my research, including the one that I'm going to talk about today at dbchan.blogspot.com. Okay, so what is order flow? Well, order flow is a very simple concept, actually. It's a signed transaction volume or signed trade size. If somebody send a buy market order to the exchange, the order flow will be positive. And if somebody send a sell market order, and of course it will be executed, that trade will result in a negative order flow. Now, long-standing academic research has found that order flow is a leading indicator of price change. It dates back to the early 2000s by Professor Richard Lyons at UC Berkeley. He wrote a book which talk about how predictive order flow is for price change in the forex market. And the reason for that is that whenever there is breaking news or whenever fundamental knowledge become known in the market, informed traders, and by informed traders we mean those people who receive the information first and are able to digest it and take action on it. So typically you might think of them as hedge funds or large proprietary trading firms. These people who know something about which direction the market is going to go, they will immediately want to get into a position based on that breaking news, based on that new information. And they will, because they are in a hurry to get into the market, get into position before everybody else, they would be issuing market orders. They are not going to just send out a limit orders and hope that it will execute, because they feel that their information is fresh off the press. They want to get into the position faster than anybody else. So market orders is pretty much the only way you can achieve that urgency. And in the industry, we call these kind of trades or these kind of orders toxic flow. It's toxic because it's toxic to the market makers, because market makers, even if they are institutional market makers, may not be the one who possess this kind of knowledge or may not possess this kind of analysis or models that tell them where the market is heading in the next while. And so if you are a market maker and you take the other side of this trade, most likely you're going to lose money. So that's why in the industry they call it toxic flow. And toxic flow is generated by market orders. Now, interestingly, you might think of this kind of toxic flow as occurring at high frequency only, but that is not true. Order flow, long-standing research has found, can be predictive at different time scale, not just as the high frequency. And in fact, the example, the strategy that I'm going to talk about today is based on order flow over a full day, 24 hours, and it predicts return over the next 24 hours. So it's pretty low frequency. Now, let's put some numbers on this. We have explained at a high level what order flow is, but let's put some numbers into this concept. Let's say I send a market order to buy 1 million euro USD. The resulting order flow of this order, which will be executed. I mean, order flow, despite the name, is not really about orders. It is really about executed trade, right? But it's we only count order flow if there's a trade, not just when there's an order. But of course, if you send a market order, there is going to be a trade that follow, and the order flow that result from this market order will be 1 million euro. Nothing more or less than that. If you send a market order to sell 5 million USD JPY, well, naturally, the order flow for that trade will be minus 5 million USD JPY. It's very simple. Now, of course, this is the order flow due to one particular trade. Typically, when we want to use order flow as a predictor, we want to apply some kind of moving average to the order flow over some period of time. So let's take a look for concreteness further, to be more specific, let's look at the data that we can obtain from FXCM. This is a 2017 a piece of the order flow data from FXCM in 2017. You will see that they have 4 columns. We have the date and time. This time is in UTC up to the millisecond. It's very, very high resolution, this data, up to the millisecond in UTC. And then, of course, the symbol of that pair. And then the quantity. That means how many units of that pair has been traded. This is not order. Again, I want to emphasize, these are executed trade. And you notice that the quantity come with a sign. It's not always plus or 1,000. Sometimes it is minus 1,000. So this quantity give us the order flow generated by that executed trade. It has a sign to it. And then finally, the rate. The rate is simply the price where that trade was executed at. Okay, so they have 4 columns from this data set. And I would like to use this data set. I had used this data set to compute the daily order flow of one specific pair, as an example, EUR/USD. Okay, but before we go out and compute order flow, let's do some sanity check on the data. And that's always a good idea. Whenever you get a new data set, no matter how simple, if it's even just price data set, you always want to perform some rudimentary statistics and sanity check on them, because you never know if the data is properly created. So the first sanity check is that I want to pick out all the so-called buy market trade, the trade that are resulting from buy market orders, the trade that has a positive order flow. I want to take those trade, look at their price, and I call them buy price because these are the trade resulting from buy market orders. So I call them buy price, and that's represented by this yellow line up here. This is what the buy trades price look like. And I want to compare that to the bid price at the same time. Now, if the data is reasonable, we would expect that the buy market order to be executed closer to the ask price, right? We will be at least higher than the bid price. You will not find a buy market order so lucky to be executed at the bid. That would be too amazing, right? That doesn't happen. So let's see if that's true. And indeed, most of the time we'll see that the buy price appear above the blue curve, which indicate the bid price. So that passed one sanity check. And similarly, we plotted the price, the trade price due to a sell market order. And again, we would expect this sell market price to be lower than the ask price, right? When you send a sell market order, you expect it to be executed near the bid, not near the ask. And indeed, you will see that most of the time, the ask price is above the sell price. So it passed that sanity check. Now, it is not 100% true, because after all, there are many instances where the quote might have moved in the sub-millisecond time after the trade has occurred, and it might appear to violate that rule that the sell market order should be always below the ask price and so forth. So that happens sometimes because of this delay in reporting a trade or a quote. So, but by and large, these relationships hold, which certainly give us comfort that the data makes sense. Okay. Another sanity check is that we want to check the hourly volume. Remember, the order flow is a signed transaction size. But if you take the absolute value, that just turns it into ordinary volume. And if we aggregate the transaction sizes over hour, we will get the hourly volume. And it is a very good check to see if the trades are reported, the timestamps are correctly reported, right? We have up to, as I mentioned, up to millisecond timestamp, but here we aggregate it into hourly bins. And for this particular pair, lo and behold, the highest volume occur between 15 to 16 o'clock London time. Okay, so you see a peak there at between 15 and 16. And generally in the afternoon is pretty high, but the last hour of that trading day is the highest. That is also very reasonable, very comforting. This profile of the hourly volume, you will see in many research, many papers. So the fact that we can recreate this kind of almost like a bell curve shape of hourly volume profile is comforting, because it means that we're doing something right, and furthermore, more precisely, that we get a peak between 15 to 16 o'clock London time. That's also excellent. What is the reason that there's a peak at the 16 o'clock London time? Well, because as some of you may know, 16 o'clock is what's called a fix. The fix is where the benchmark rate for a lot of these forex pairs are determined across many of the large banks in London. And if you've been following the news, there's a lot of controversy surrounding this fix, because it has been manipulated by some of the row employees in some of these banks. It triggered multiple international investigations by the British Financial Conduct Authority, by the US Department of Justice, by the EU authorities, but that doesn't concern us. We just know that there is a fix and there's high volume, right? Okay, that's just for your amusement. That time seems to be very important to a lot of the forex traders. Okay, now finally we are going to look at the order flow. Now here we binned the order flow in quintiles. What quintile? Well, we look at the daily order flow and we look back about 20 days. Okay, we look back 20 days and we categorize today's order flow into which quintile over this last 20 days of order flow it belongs to. So the fifth quintile means that today's order flow is in the highest 20% of daily order flow in the last 20 days. The lowest quintile, on the other hand, means that today's order flow is in the lowest 20% of the daily order flow over the last 20 days. Okay, so this is the way that we rank today's order flow based on what happened in the last 20 days. And for each quintile, we plot the average next day return. We compute the average next day return. Okay, again, this data is only coming from 2017. So we do this for a whole year and we plotted this distribution. You might call this a histogram, okay? It's a histogram on the daily flow quintile, but the y-axis is not the number of days with such daily order flow, but the y-axis represent the average next day return. Now this chart is very, very gratifying because it tells us that those days with the highest order flow, relatively highest order flow, generate also the highest next day return. Whereas the day that has the lowest order flow, well, it doesn't exactly generate the lowest daily next day return, but it's pretty low. It's second lowest next day return. Okay, now what happened to the middle one? You might think that is a little bit of an anomaly. That we only have 1 year of data, 250 bins, so you can't expect everything to be so smooth. So the middle bin is a little bit of an anomaly. We shall ignore it. Sometimes you have to impose your own prior knowledge to this kind of data. You don't have to accept everything completely, especially given that you only have 250 data points. Okay, so but generally, if you look at the bottom bin and the highest quintile and lowest quintile, the relationship between the future next day, the next day return and today's ranking of the order flow follow a pretty monotonic pattern. So next day return is almost monotonically increasing with the previous day's order flow. If you want to compute the difference in the quintile returns, the top minus the bottom quintile returns is about 12 bips. 12 basis points. If you analyze that, that's going to be about 30%. Now, that doesn't mean that if we trade this strategy, we will earn 30% annualized return a year, because we cannot arbitrage between the top quintile and the bottom quintile. These two quintile happen on different days. They are not contemporaneous order flow of different pairs. They are time series quintiles. That is to say, some of these days you have the bottom quintile, and some of these days you have the top quintile, and they differ by 12 bips, but that doesn't mean you can arbitrage between them. Okay, it's just of side interest, what kind of magnitude we're talking about in terms of the difference in the bottom and top quintile. Now you might think that, okay, since it's kind of monotonic with order flow, a linear predictive model would work. That is to say, can we just say, we should adjust our position to be proportional to the order flow. If the order flow is big, we will have a big positive position. If the order flow is small or negative, we should have a negative position. That is a short position, with the magnitude of the position proportional to the order flow. Well, unfortunately, I've tried it, and the linear predictive model doesn't work very well. But that's very common in trading. A lot of these trading models are non-linear in that sense, that you only can extract alpha based on the extreme quintile or the extreme quantile in general. Maybe decile, maybe quintile, maybe quartile. But generally speaking, the middle quantiles, they are not very predictive. Even if you can see a fairly monotonic increase, you cannot really use them in a linear model very well. And that's actually commonly found in other areas of finance as well, whether you're ranking stocks or futures and whatnot. Okay, and we find that to be the case here as well. Okay, so now what is the strategy that we propose given this quintile histogram? Well, it's easy. We would just say that if the aggregate order flow in a day is in the top quintile, based on the last 20-day statistics, we will buy and hold for 1 day, because after all, it has the highest 1-day return for the next day, right? We suppose to have. And if it's in the bottom quintile, we'll short it and again hold for 1 day. That's a simple strategy that we can extract. Now, what the performance is looks pretty decent for 2007. Again, I do not suggest that you immediately go out and, oh, by the way, and compound annualized return is 13%, Sharpe ratio 116. But I don't suggest that you go out and immediately trade this strategy, because the data is only based on 1 year research and it's only based on one pair. So it could well be, data snooping bias. You should definitely confirm it with out of sample data before you go out and implement the strategy. In fact, you should study this strategy, apply this strategy to different pairs and see if they work as well. And also, you should study whether a cross-sectional order flow strategy would work. What I have shown you earlier is what we call a time series strategy. That is to say, we are looking at one pair at a time, and we are comparing the order flow of today with the last 20 days. That's a time series strategy. A cross-sectional strategy would compare the order flow of each forex pair with other forex pair and rank them across the different pair. And perhaps you would then buy the pairs that rank high and short the pair that rank low. So this would be a cross-sectional order flow strategy. That's I haven't tried, but it's quite a heavy computation, because you need to compute the daily flow for all the pairs, not just one pair. And there's a lot of data, because the data is, as you remember, in tick format, and it has millisecond resolution. So there's, you make sure that your computer is fast enough to handle all these pairs to run a cross-sectional strategy. And then finally, of course, you should try the different look-back period. 20 days may not be the best. Holding period of 1 day may not be the best. So try different look-back and holding periods, and again, optimize it in sample and see if it still works out of sample. And of course, you should get more data. I understand that data beyond 2017 is now available, so you should get those to run the out of sample test as well. So these are some of the possible refinement and modification of the strategies. Now, there's one other idea you could try, and that is that order flow is not just useful for alpha generation. A lot of people use order flow as a risk indicator instead. It can be used for risk management. And that is because, as I mentioned, order flow indicate when there's a breaking news and a lot of traders who are informed traders suddenly decide to make a large urgent trade in the market. So, and oftentimes, if you monitor the order flow of those so-called risky assets, things such as Mexican peso, South African rand, or outside of forex, you might think of them as, you might think of junk bonds, or even emerging market equities. These are very considered risky assets. So typically, when there's breaking news and traders interpret the breaking news as being bad for the world economy, they will immediately dump such assets, such as the peso, such as the South African rand, and so forth, emerging market currencies in general. So if you are able to monitor the order flow of these risky assets, you get a pretty quick early risk warning sign, a quick risk indicator. On the other hand, in those stressful periods when there's bad news, traders oftentimes will buy up assets that they feel have the lowest risk, things such as Japanese yen, such as US dollar, of course, and such as Swiss franc. So you can monitor the order flow of the emerging market currencies versus the developed market currencies, especially USD, JPY, and CHF, and you will see very quickly, people trade, the high frequency trader trade very quickly, that there is bad news hitting the market, and you should get out of your risky assets, whether it would be junk bonds, or whether it be equities, or emerging market bonds, or emerging market currency. You should get out of it quick, because people in the know are already taking action. So this might be a faster way to avoid losses, to protect your asset, than to monitor the news yourself, because a lot of time these news, you don't know how to interpret them, and it's pretty hard to parse news or use sentiment indicator. Well, order flow is a sentiment indicator, and it is easiest and faster than other sentiment indicators. So that's another interesting use of order flow, not for alpha generation, but as a risk indicator. Okay, so now that we have some examples of how we might use order flow, you wonder how one can get our hands on it. Fortunately, as I mentioned, all this data come from FXCM, and I'm grateful that they allow me to backtest strategies based on that. And also, they also provide it as a live trading, live data feed. FXCM provide what is called a REST API. What is a REST API? A REST API is a web-based API that makes use of WebSocket connection. It is very, very easy to retrieve data. You do not need to be a high-power programmer to do that. You can retrieve the historical, you can use this RESTful API to retrieve historical data or real-time market data, or even place trades. So it's a complete trading API. Okay, you can do everything using this API, and you can use any language that support HTTP. Basically, even you can almost use a web browser to retrieve this data. But of course, that would not be useful for automated trading. But any language that support HTTP, Python, JavaScript, MATLAB, R, whatever, you can use that to retrieve continuously these kind of data and place trade through it. The data that is retrieved from the API would be in this universal JSON format, and many of these languages have built-in parser to parse a JSON format data, so that's also very easy. If you want to check out the API, here's the URL that you can follow. I've displayed the URL to that RESTful API that you can use. Okay, so what's the conclusion? The conclusion is that what we talk about is that order flow is actually a well-known indicator, a leading momentum indicator. It's momentum because typically when order flow is positive, you expect a positive price change and vice versa. And it can be used at different time frame, not just 1 minute, 1 hour, 1 day. Okay, historically people have studied days, multiple days aggregate of order flow, and still find it to be predictive. Now, the problem with order flow in the forex market is that traditionally it has been hard to obtain because most forex brokers do not disclose their order flow to clients. They keep it tight to the chest because they know that it's very useful. It's a very precious data. I was not able to find out how I can get it for years, even though knowing that it's predictive in the forex market. But so now we have an interesting opportunity where FXCM is providing that as a live data feed, as well as providing that as a historical data feed for your backtest. So it is quite a interesting development because nobody else have been able to provide that until now. And so once I got my hands on this data, I tried it on a simple 1-day strategy, and it does have predictive power for that one pair. But again, do not trust the backtest on just one pair over 1 year. Make sure that you try it on multiple pairs and and using more out of sample data first before you go out and trade that. But beyond being an alpha generator, it is a very good risk indicator, early warning sign that you can use not just on your forex portfolio, but on all the risky assets that you might be holding. It is a early warning signal for the risk-off regime. People talk about risk on and risk off. Well, order flow is a very good risk on versus risk off indicator if you monitor the right pairs. So thank you very much for your time today. You can certainly contact me through one of these ways, my blog, my website, and my Twitter feed. And I'm certainly happy to answer any questions that you may have. Okay, so let me answer some question here. There's a good question about a trade has two sides, right? That order flow oftentimes confuse people because they say, well, a trade, there must be a buyer and a seller. So how can you compute the sign? What does it mean by a buy trade? Well, the crucial thing is that we are only counting the trade resulting from a market order. We assume that the market, the side that uses a market order is the side that has information. That's the informed trader. So there is an asymmetry there. You cannot, two market orders cannot interact with each other. You only can have a market order interact with a limit order. So on every trade, there is a market order and a limit order, and we only count the side of the market order. Okay, let's see. Yes, someone asking about the recording. I believe that FXCM will make the recording available. I'm sure of that, but certainly please follow up with the organizer. The order flow is limited to one broker. Pierre, that is correct. Yes, I mean there's a certain limitation to it because this is the data provided by FXCM, so it doesn't cover all other broker. Now, whether that's representative or not is something for you to backtest. Nobody know ahead of time whether a sample from one broker is sufficient to predict the market. Right, that's something you have to explore yourself. That's just like the opinion polls, right? Clearly you want to find a opinion of accurately for everybody. You have to poll everybody, which is impossible. There are millions of people. You cannot call them all. So the polling firms might poll randomly 1,000 people, 2,000 people, and publish it. This is have the same spirit. Is the FXCM order flow representative of the market? Well, who knows? Something that you have to explore by backtesting. The question about whether the order flow or the volume that I talk about is tick volume. No, as you recall, we did a aggregation per hour or per day, right? In the study of the hourly volume, we have added all the tick sizes over the hour. And in the case of the order flow strategy, we in fact added all the order flow due to each tick over the whole entire day. So, given the tick order flow, you can aggregate it to whatever time frame you like. There's a question about whether we take note of the cancel orders or the rate of cancel order on the order book. Once again, please note that the data we have here are executed trades. Despite the name order flow, this is not about order. It's about executed trade. The only thing that we learn that the only information from the order is that we know that trade was due to a buy market order or sell market order. But otherwise, we have no idea what the order book is. And furthermore, definitely we don't know anything about whether the order is canceled or not. So this is not a data feed that tells you quotes. There is no quote information. There's no order book information. This is only executed trade, but with a sign to that trade. Okay. A question, there's a comment that says, what I have presented is not order flow. Depth of market is. Well, that is what you said is incorrect, unfortunately, Sebastian. textbook definition of order flow is exactly what I described. If you don't believe me, you can check out Professor Richard Leon's book published in 2001. It is universally accepted that order flow is defined as the signed transaction volume. Okay, let's see. Is there a relationship with futures order flow? Yes, I expect so. You know, if you're talking about the you can compute the order flow of the forex futures, I expect a high degree of correlation with the order flow of the spot market. Now, that, however, doesn't help us very much, because how do you get the futures order flow? Well, one way to do that is to subscribe to the CME MDP feed. It's an extremely expensive data feed that will tell you the order flow of futures. But even that doesn't help you very much, because the forex futures market does not have a lot of trades. It's not very liquid for some of the emerging market currency pairs. So actually, spot market is much more liquid than the forex futures market. Besides the point that it doesn't make it any easier for you to obtain order flow on the futures market relative to the spot market. Okay, so in terms of where you can see the order flow indicator and what is the cost, you can certainly, the organizer can can answer that. And then in terms of the video for using the API, again, that's something that the organizer will have to, they may be able to upload a how-to video on the website of the API as well. The order flow data, whether it's available for MT MetaTrader client. Now, I'm not sure about that. I think at the present time, only the REST API is providing that data flow, but certainly an interesting idea for FXCM to consider to make it available through MT MetaTrader client. Yes, a question about whether a time frame of 1 hour would work. I do believe it would work. In fact, sometimes even 1 minute would work. But that's something one have to backtest to find out. I have not, and sometimes it depends on the pair. So it's something that the one has to backtest to find out. Now, the time lag for the time series forecasting, that means the look back. Somebody asked whether that, how do I pick 20 days? I admit that 20 days is an arbitrary number. I have not tried to really optimize it, and that's why I suggested that you should try to optimize it in sample and see if the optimal result is holding. It holds in the out of sample test. I picked 20 days because it's about 1 month, and it sounds reasonable. You don't want to be lower than 20, because how do you get 5 bins, right? If you have fewer than 20 numbers, it sounds impossible. But you don't want to be too long, because things, the market regime changes a lot if you are farther than 1 month. So, but that's ultimately is a variable that one has to optimize. One question is that you have to see the volume of bid ask and see how orders being added and subtracted. That is not necessary. If you have that kind of data, yes, you can also compute order flow. If you don't have the sign attached to the volume, you can infer order flow from looking at the order cancellation and order addition to infer how many market orders on which side has been filled. That is true, but you don't have to. And in fact, I do not believe FXCM is providing you with that data. So that's not so that's an alternative way, but that is not implementable at this point. With any broker, not just with FXCM, no broker I can tell you, will give you that level of resolution for the order book at the moment. So the question is, are you actually automating this trading? I have not implemented the strategy. As I said, this strategy is more of a illustrative purpose only. I do not recommend you to immediately go copy it and trade it. So I definitely have not automated this strategy for live trading at this point. I need to research it further before doing all the tests that I have recommended before we go ahead and trade it live. But yes, in principle, there's no reason why we cannot automate it. As I said, the order flow data can be retrieved using any program, whether it's Python or MATLAB. And even after you retrieve the data, you can do the computation in that program, Python, MATLAB, R, whatnot, C++, C#, and then or even Visual Basic. And then after that, actually, I don't know if Visual Basic allow HTTP connection. That's a different question. After that, you will be able to send orders through the same program. So it's actually pretty easy to automate if you were to go ahead with this kind of strategy. There's a comment that says that you would have to need to trade futures for accurate data. I actually don't understand what that means. As I said, if you're talking about forex futures, actually for a lot of less liquid pairs, the CME forex futures are illiquid. They don't give you much information at all. Now, of course, if you're talking about USD, EUR USD, no problem. CME futures are pretty liquid on that, or USD. The major pairs, no problem on the forex futures. But if you are trying out some less liquid pair, actually the spot market is more informative in that case. Can you use the change in volume size or rate of change in price as well? The rate of change in price, potentially yes. There's no reason. The point is that you do not, you do not need to use only one indicator. Order flow is a very good indicator, but there's no reason you cannot use it together with other indicators such as change in price, rate of change in price, or change in volume, and so forth. There's no reason not to. So, question about what program I use to backtest and analyze the data. Yes, indeed, I have used MATLAB to do that. There's a question about what do I need to be so that you are not off quote when the market moves. Well, I think that if you are into this kind of fairly high frequency opportunity, you do need to co-locate, and I believe FXCM for certain client you can co-locate with their trading server, so that it will take less than 10 milliseconds for your order to get executed on the FXCM market. There is a question. They say that not all trades are at market. That is actually not true. Every trade is the result of a market order interacting with a limit order. Now, you might be thinking that you're sending a limit order, but if your limit order is marketable, that's treated as a market order. Essentially, a market order is defined as an order that is immediately executable. And essentially every trade is the result of one such an order. So there has to be a quote change, okay, in order to have a execution. Even if there's nobody send a market order, even if they are just changing the price of a resting limit order, well, as long as you change the price and make it marketable, that becomes a market order, and that is the side that generates the order flow. I don't. There's a question whether we need machine learning or linear regression for this. Definitely not. As I pointed out, linear regression doesn't help at all. You are, in my example strategy, you only need to sort the order flow into quintiles based on its last 20-day values. Or if you are going to backtest a cross-sectional strategy, you also can sort the pairs order flow into quintiles or into deciles and trade accordingly. No machine learning is required, and in fact, I haven't found it to help in this respect, in this simple strategy. Now, that doesn't mean that you can't use machine learning to develop a more complicated strategy, particularly if you want to use order flow in conjunction with other indicators, maybe return, maybe volatility, or any technical indicators that you might come up with. You want to mix and match them and put them together in a complicated model. Indeed, machine learning might be necessary for those situations. FXCM, there's a comment that says that FXCM do give real volume, but it's on a separate server to the price. Well, that's might well be the case, but volume is a different thing from order flow, right? There's no sign to the volume. Well, I mean, volume can be useful too, don't get me wrong. Even without the sign, you can use this data in many different strategies that involves only volume. But the beauty of this data set is that it does provide you with a sign, which is very important information. So you get the best of both worlds. You can use this data with the sign or without the sign. Yes, the book that I mentioned. If you just go to Amazon.com and Google and search for Richard Lyons, Y-L-O-N-S, there will be there's a book that comes out, quite obvious. It's it probably has the order flow in the name, but I cannot remember it very well. But it's still in print, so you just have to search for Richard Lyons on Amazon. You will find his book on the FX. Okay, let's see what else. Order book may be useful. Yes, indeed. Order book has some information that are different from the order flow information, and that might be useful. I have not studied the order book information for FXCM, so I cannot comment on whether for sure it is or not. Okay, let's see. There's a question of whether you have to download every time and backtest. Well, I'm not sure exactly. I have not used the RESTful API myself, but I imagine that you can download a fairly decent long history and then use that for backtest. But of course, if you want to again download the latest data, you would have to run it again to download the latest data. But otherwise, you can save that data. When you download, you save that data and you can backtest it. There's no reason that you have to keep repeating your download for the same data. You can save it, right? A question about an example of how I implement a strategy using FXCM trading station. Well, I think that probably best answered by some of the developers at FXCM if you want to do that. I personally do not use the FXCM trading station for implementation, so I'm not the best person to suggest how you might implement that. But that's an interesting suggestion. If FXCM trading station can incorporate the order flow as an additional data feed, that would certainly make it very easy for you to backtest and trade, instead of you writing a separate program to retrieve the data from their REST API. That certainly would make it easier. It's a comment. Let's see. Okay, there's a question. When aggregating the order flow, do you sum the sign volume, or you sum the sign volume times the price? There is no reason to multiply by the price, Pierre. Order flow does not involve price, actually. It's only involve volume, sign volume. The price also doesn't change a whole lot in forex, right? It's up and down 20 basis points for the liquid markets, up and down 15 basis points. It's not going to change very much, even if you multiply the price, but you shouldn't basically multiply by the price. Okay, and let's see. Question is, are you processing the order flow manually in order to decide on trades, or do you have any engine to do that automatically? Well, obviously, if I were to trade this, as I mentioned, I have not implemented a live trading system on this yet. But obviously, if I have to, if I'm going to trade it live, I will build a program to process the data. It is not possible. Actually, it's absolutely not possible to run this strategy manually, because as I mentioned, the data feed is based on ticks. The ticks come in every millisecond. So how are you going to manually process this? It's just impossible. This strategy 100% need to be processed automatically with a fast computer, not even automatic, but with a fast computer, because it is like a fire hose, the data that you getting. They are, as I remind you, a millisecond fire hose. So you need a fast computer to process the data. And even if your trading frequency is not fast, but the data processing need to be pretty fast. Otherwise, you will be missing ticks, or the tick will be jammed up, and all kinds of bad things is going to happen. Okay, there's a question. Let me actually see. You're doing a backtest matplotlib histogram to show distribution. The histogram that I show is not really a histogram, right? Histogram by definition really means the y-axis would be the count of instances, and the x-axis would be the range of those the range of values for those instances. But that is not what I'm plotting. The plot, I can certainly go back to that plot on the screen here. The plot here, the y-axis is actually the average next day return, right? So they are not the number of days with certain order flow. That's not the case. So this is not actually a histogram. And so the standard tools that you use for plotting histogram won't work. The tick-by-tick data feed, is that pushed by FXCM? I don't think it's a push API. It's a pull API. So you have to constantly pull it, because it's an HTTP, right? HTTP, I don't believe you can be, is not a push technology. Can you repeat the idea that we should buy the largest quintile and sell the lowest quintile? Yes. Yes, the lowest quintile has the generally generate the lowest next day return. So typically we want to short it. Now you might actually, from this diagram, you might find that actually even the lowest quintile has a little bit of a positive return, but that might be a case of bias, because remember, if the average EU USD return is positive in 2017, then all the quintile next day return will be positive, right? So whether you short the lowest quintile depends on whether you believe that the entire year of the average daily return of USD is positive. If it's positive, you might not bother with shorting the lowest quintile. That's an interesting question, actually. So if you just look at this diagram, you would think that you should not even bother to trade the lowest quintile, but that is contingent on the average daily return of USD. There's no formula of the algorithm. I have already. The algorithm is very simple, right? It's here it is, the algorithm. If it's in the top quintile, buy, hold for 1 day. So there's no formula really in this strategy.